Good afternoon, ladies and gentlemen. Welcome to a Standard Bank webinar hosted by SBFC, which is Standard Bank Financial Consultancy. My name is Ketwe Gunene, and I'm the coordinator today. And we are looking at the budget speech today and how it affects you and your financial planning. Errol Mayer will be taking that through for us. But before I hand over to him, let's just do some housekeeping. Make sure that everybody's comfortable with what we're talking about today and what's happening with the webinar. So you're going to be seated for about 45 minutes to an hour for our session to come through. If you have any questions, there's a questions panel. There's a panel on the right-hand side of your screen. There's a questions heading that you can click on and type your question. Anytime during the session, you can do that. What we'll do is we'll address the question at the end of the presentation so that we don't disturb Errol while he's going through the presentation. The second thing is sound. Make sure your taskbar, if you see that sound volume button, you put that on the highest setting that you can so that you can hear us very clearly and you don't have a problem with sound. What I need now is just an indication to make sure that everybody is on board and can hear me so that we can start the presentation. So what you need to do is there's a small high five on the same bar, that small silver panel on the right-hand side of your screen. There's a small high five. If you can click that, that will indicate to me that you can hear me and we can carry on. Thank you, Tiloshni. Thank you, Sneyman. Thank you, Sam. Thank you, Musa. Thank you, Mapito. Okay, the hands are coming up. Lionel, Ken, Carl. Okay. All right, so the majority of the hands are coming up. So just remember just to put the volume setting as high as you can so that you can hear us. Okay, so let me just tell you a little bit about Mr. Errol Mayer, our presenter today. Mr. Errol Mayer is a certified financial planner and an admitted advocate of the High Court, SA. He holds qualifications in finance, law, teaching, and taxation. He's authored a book called Notes on Estate and Financial Plans, which is now prescribed for many universities. He's a renowned lecturer, examiner, and moderator for various universities in South Africa. He's previously worked as a legal advisor for corporates and as a tax advocate for SARS. He currently holds the position of advisory propositions legal specialist here at Standard Bank, which is why we trust him so much with our topics and to take us through the presentation. I hope you will get as much as you can from this and how it affects you and your financial planning. So I'm going to hand over now to Errol, who will take us through the presentation. Hello, Errol. Thank you so much for your time.
Well, thank you there, Ketiwe. And good day to all attendees and welcome to this webinar. So what we're going to discuss is the post-budget speech and financial planning. Now, it's been exactly a week since the budget speech was delivered. And you must have read quite a lot in the press. And many people said, well, it was more to do with the upcoming election. And we focused a lot on economics. And then came the bombshell, very little on tax. But in a budget, you still have to balance your income and your expenditure. So how did they go about? So we're going to unpack that a little bit. But most important here today is to connect those dots and say, or ask the question, how does this impact on me, the consumer? And what should I do from a financial planning point of view to overcome these difficulties? So I'm going to spend quite a lot of time unpacking some fundamentals and then taking into account mainly on the relating to taxes and not on the Eskom and the economy. We've heard that already, and there are many views out there. So let's focus on that, and let us start off by putting some kind of agenda together. So what I'm going to be telling you, first of all, I'm just going to put the budget speech. What is it? And put that into perspective. And I'm going to make sure that you understand what is meant by bracket creep. So often we use those words, but do we know exactly what it means? And furthermore, how does it affect us? And the best way to do that is by means of an example. So I put some calculations, simple calculations together so that we can see some kind of reasonable result. But I thought it would be prudent and interesting to take a walk down memory lane and go back into the past up until sometimes 1996, 2001, up until today. And let's go and analyze all those income tax tables and when capital gains tax came into being, and see how did we actually do, how did things change? Because looking back into history can give us some kind of indication what's going to happen in the future. And after all, financial planning is about looking into the future and making it present so that we can decide what actions is it that we should take today. And this is where we want to get to. We want to find out what actions and how should I go about in my financial planning strategy in order to ride the rough seas that we are finding ourselves at the moment. Because we know, like with any storm, it may be rough out there, but there will be times when it's calmer, and then you wished that you did your planning. And this is what today is all about. So then the third block, we're going to talk about some definitions. What is financial planning? And I can actually tell you it has a lot to do with number 4. It's about strategies. To strategize in order to reach your goals. And we're going to talk about that. Term is a very, very important concept when it comes to goals-based financial planning and it comes to investing. Because term is something that can really help us to reach those goals, but it's also something called time that is running out for all of us. And then we're going to talk about inflation, and you will soon see that this budget was all about inflation and bracket creep, and we'll unpack that in more detail. Now, people are going to react differently, and the human behavior is so important. So financial planning has a lot to do is how do we harness and harbor those fears and those greedy elements, and the way that we go about when we make decisions for the future in the respect of our goals and our investments. So let's go and revisit the fundamentals and we put it in place and say, are we still okay? Can we move forward? And then I'm going to do some applications. I'm actually going to give you an example that I think we can use as a template. And how should you go about with budgeting? It's easy to tell you, take your income and your expenditure and see what you've got left. But I think we've got to be a little bit smarter. And I'm going to follow the goals-based financial planning philosophy way and try and unpack it and show you how is it that we should go about. So, having said that, let's move on and talk about the budget speech. Now, first of all, the budget speech is about the economy of South Africa. Fact, it's about the government spending and revenue. So let's have a look at that, and then let's see how does it relate to our personal budget. Now, where does the word economy come from? It comes from the Greek word oikos in the main, which means, quite important, to manage the household. So simply put, economics is a study of how human beings match their multiple needs with scarce resources. And that is exactly what goals-based financial planning is all about. And that is the solution. So the annual budget gives us a breakdown that makes up the government's finances, namely government spending and government revenue. Revenue is mainly derived from taxes and loans. Now you think about your personal budget. Where do you get your revenue? Income and loans, short-term and good long-term loans. Now, it is at the budget speech that we hear of tax changes and how the deficit, the amount by which planned spending will exceed planned revenue, for instance, the Eskom, how will that be financed immediately or over 3 years, etc. Now, we are stuck in kind of a dilemma because government can only raise so much taxes. And this year it was quite clear that they couldn't really rely on that too much, because we've heard about the Laffer curve, where it simply states when you get to a certain point, if you want to collect or increase the tax rates, you're actually going to collect less. And we've been talking about for the last 3-4 years, and it seems that this is what could have happened, and this is where we're now. So the rates were not increased. But is that true? And we will analyze. Now, your personal budget, it's exactly the same. It is about the economy of the household. But here we have options. I told you that one can one will receive income, and that could be in the form of salaries, investment income, or being an entrepreneur. And then that's got to match expenditure. There's one thing or one option that we have that government does not have. We can actually increase your income. And I often tell that to people going to retirement. I'm so sick and tired of hearing that I can't retire, I don't have enough funds. Well, you have options, don't you? Be more productive. With other words, start working 5 years before going on the retirement and some kind of goal. Use a tax-free savings account, have some monies available in order to start some small business and to increase your income. This is a strategy. And this is what financial planning is all about. It's all about those goals. Good. So let's move on and talk about strategy. There's an hours. So it's quite clear what happened this year. The strategy in order to collect those taxes has changed the first time in many years. So much so that I coined this, that inflation is the enemy of the consumer. That is who we want to beat. But now, in this budget speech, it clearly became the friend of Treasury. And that is a mismatch. So, marginal tax rates did not increase. So the real issue is about budgeting, that disposable income. Now, you must bear in mind, inflation didn't stop. It continues to tick over. When you look at my example, a basket of goods, there you see 4 coins. Now, with that basket of goods, you needed 4 coins. But the next year, and the next year, and the next year, you need actually more to buy the same basket of goods. When you don't have more money, what's going to happen? The basket of goods is going to become less and less. And that is your household expenditure, that's your medical, that's your contributions, and that's your savings. And that we cannot allow to happen. That is the last resort. And if we get to that point, we're going to talk about priorities. So part of goals-based financial planning. And I'm going to show you examples. So there we've got it. We're going to talk about inflation because this was the friend of Treasury that they used this year because they did not increase the inflationary brackets, which could have a negative effect on the taxes you are paying. But before we get there, let's go back a little bit in history and do some time traveling. Now I went back and I looked at the income tax tables of 1996. That's where we've got the records at SARS that I could pick up on the SARS website. And then I took another one randomly 10 years later, 2006. That wasn't that long ago. So let's look on the left-hand side. There we look at the tax tables. You only started paying tax when you earned 5,000 Rand. Over and above that, you would have paid 17%. Today it's 18%. Remember, these brackets are adjusted by inflation year on year on year, and that happened every single year, but not this year. Look at the maximum taxable income where you'd be paying, and note there, 45% marginal tax rate. So on 80,000 in the year 1996, you would have paid 45%. Now the knee-jerk reaction may be 45, but that was high. That is not really the test. The end of the day, what you have to calculate is that effective rate. What is the actual cents in every rand that you are paying? It has very little to do with that marginal rate. So we can see in the table next to it in the year 2006. Now you will recall this is when things really started going well for South Africa, and we saw a lot of tax adjustments, and tax was actually decreased, and it actually happened. But interesting, 10 years later, your first bracket starts at 80,000. That's a jump from 5,000 to 80,000. That's quite a lot. And who's responsible for that? Inflation. But look at the maximum bracket of 300,000. But the tax rate at the marginal rate was only 40%. So we move on to the following year. And then in the year 2017, we find that the brackets has jumped to 188,000 and the marginal rate at the bottom on the left-hand side table, you will see is 41%. And so we get closer to last year. Now we know that last year's tables and this year is exactly the same, except for some small changes. But let's have a look. It was only in 2017 where the rate was 41%, a marginal rate, and it was at 700,000. And the next year, in the year 2018, they introduced a higher one of 1.5 million. And this was the shocker last year. And this is where I said, I think we got to the top of the Laffer curve. And it's not about income tax, it's about all taxes. I'm just talking about income tax. And there it went up to 45%. You'll also see that there are rebates. Now, those rebates, it's nothing else than a credit. A credit is what you get towards the actual tax you are paying. So they talk about the primary rebate. Those years was 13,635, and that was increased the following year to 14,000, and in the current year, it increased a little bit more to 14,220. But it is actually an age credit. If you're younger than 65, you get the credit. And technically, I think they should call it a credit. Because when we talk about medical aid, we don't talk about deductions. We talk about the credit. So depending on how many dependents you have, you will get a credit. And that comes off your income tax. Now, that has increased gradually. And that's the only place where there were such a small change. It's actually 153 Rand. That is the relief we got, which means absolutely nothing. So let us jump then to where we are now in the budget speech, and this is for the years ending 2020. I think it's the 29th of February 2020. It's not this year, it's the following year. Yes, the 29th of February. So as you'll see, the brackets are exactly the same than the previous one. Nothing has changed. But the primary or the age rebate or credit, as I call that has changed to 14,220. It's not on the slide, but it increased with a mere 79 Rand. So let me just make a little bit of sense out of that. So people talk about the threshold that went up, which seems like it sounds great, but it is not so. That threshold is calculated with reference to that age credit. So if you would take the age credit of 14,220 and you divide it by 18%, which is equal to the first bracket, you will get 79,000. And last year it should have been, based on the same calculation, 78,000. So you heard about that increase. Effectively, the increase was only a mere 153 Rand. So the tax threshold is just a calculation. It actually means very little at the end of the day. And now, medical credits stayed the same, unless you have more children. But if you have yourself, spouse, and 3 children, depending on how many dependents you have, you will qualify per dependent for a medical credit. So yourself and your spouse, or yourself and the first dependent, will be entitled to 310 Rand, and then for every child would be 209, or for the third, fourth, or fifth dependent, whatever way it is, then it would be 209 Rand. That stayed exactly the same. But surely medical aid cost increased with inflation, but our credit that we get stayed exactly the same. So let us now jump to capital gains tax, which is part of the income tax. And I also want to go down in history. And I want to point out to you how inflation is actually being used slowly over these years until now, where we have a fully fledged, call it then, attack where we use the inflation. Now, capital gains tax is on your capital profit after 2001 that you will pay a tax. Now, if you look at my table there, in 2001, 1st of October is when capital gains tax was introduced. So if you look at the annual exclusion, it was only 10,000, and then if a person would die in that year of assessment, it was 15,000, which today is 300,000. But note here, the inclusion rate of the capital gain was only 25%. Do you know the reason for that? That was because those years, it was decided it's going to be too difficult to index this bracket cream, to index it there and to adjust with inflation, the growth, because the growth of an asset has a lot of inflation in it. And for that reason, they say, we will call it at 25%. That was the deal. It was because of inflation. And so it continued until the year 2012. And what happened then? In 2013, it changed course and they increased the inclusion rate to 33%. Remember, the idea was that it is to make up for the inflation growth in an asset. So we are being taxed since then, 2013, from a capital gains perspective. And guess what? In 2016, and this is the current position, the inclusion rate is 40%. So when we hear in the press people talking, everyone is onto the income tax tables. But this applies to transfer duty, to capital gains tax, to estate duty, because inflation are all in all those assets, and then you slap on a 1% VAT. Now the picture changes, because what is being affected is our disposable income. So tax is not the only aspect that we must take into consideration. So let's go a little bit further and we look at the effective rate. So what I've done is I simply adjusted with inflation, and I just took 6% to be fair, because it could be a bit more, could be less. It depends on year and year, all kinds of methods. So I just took a 6%. And I say in 2001, if you bought an asset for 500,000, you bought the asset with a market value, that's 500,000, and you bought for 250,000, then your base cost is 250. Then your capital profit is 250,000. Is that not so? Then this is on death now. You qualify for exclusion of 15,000. The inclusion rate was 25%. Your marginal rate was 42% then, and therefore the tax you are paying is 24,000. But what's important, the percentage that you paid, your real cost, is 4.9%. And so I do the same for 2013, and I've just adjusted with inflation. And I applied the tables of that particular year when the inclusion rate then moved up to 33% and the marginal rate was 40. It has increased to almost 6%. That is now real income. That is a real disposable income I'm talking about. And if I do that for 2016 at the current rate, and which is applicable today as well, because the rates are the same, then you will see that the percentage has jumped almost to 9.7%. So here we go. Inflation over these years really has become a strategy, so much so that in the event of death, cash flow, just like it is like disposable income while you're alive, cash flow at the moment of death is absolutely crucial to ensure that your goals are protected. Even there, our liquidity has become less and less, which makes it crucial for us to do financial planning and say, give me a snapshot in the event of death, or a snapshot this year with the taxes that I'm going to pay and with increased inflation, how much do I have available? Then for the sake of interest, what I also did, I did from an income tax point of view and say, what was those effective rate? In other words, how many cents are you paying out of the rand? In 1996, even though you will recall, I told you the marginal rate was 45%. Your effective rate, that's after your age credit, was 32%. Then in 2006, it dropped to 29. Where are we now in 2020? Remember, now I'm talking about your actual tax being paid, 37 cents in a rand. So we actually became a lot poorer, which means that we are in rough waters, and we are really, our planning and our strategies so much smarter. Now, for the middle class and the poor, the wealthy, I'm sure, won't feel it that bad. But we have to formulate strategies. This is where financial planning is really going to add value to the consumer, to be able to crunch these numbers and to help formulating strategies, to learn from one another. What strategies are they employing? Is it better to pay off my bond? How should I go about? Well, let's answer those questions just now and see if we can drill down in a bit more detail. Estate duty, everyone wants to know about that. Well, there you are for your information. I'm not going to go into detail. In 1998, it was 15%, and then it jumped to a 25%. And then you'll see in 2001, because capital gains tax was included, also a tax payable on death. So they reduced the rate to 20%, and then all of a sudden, and now it is 20%, but if it's more than 30 million, which is not on the slide, which happened in last year, and now part of legislation, over 30 million, you'll be paying 25% for the higher, the wealthier person. A lot of people expected that the estate duty rate would increase. In a way, I'm pretty surprised that something did not happen. But I guess view was taken that we're going to focus on certain things, which is the tax collection and tax administration. And now is not the time to think about where the wealthier can contribute more. But let me make this point. I think they missed an opportunity. If you think that the VAT rate increased 1%, that had a direct impact on everyone. Now, if you look at the Davis Tax Committee, the real problem that we have, and now in the World Economic Forum, it actually came out that we're one of the worst. The gap between the poor and the wealthy is becoming bigger and bigger and bigger. Now, the VAT rate only caused, to my mind, that the poorer was sliding more and more, that this gap is widening and widening. I imagine with the wealthy, it did not have that impact. And this is where wealth taxes is relevant. And Judge Davis said, in the Davis Tax Committee, he said, you know what, forget about these wealth taxes, put it very simply. But those recommendations that we made, that, for instance, the spouse's deduction and the spouse's rollover, which simply means if I bequeath all my assets to my spouse, I don't pay estate duty or capital gains tax only when she dies. He says constitutionally one can argue it shouldn't be allowed. So if they only implemented that, it could at least have some impact on ensuring that the gap between the poor and the wealthy, the Gini coefficient, doesn't become bigger. Because once it becomes too big, what we have, you will have social unrest because it's unfair towards especially the consumer. But by the way, that was an expectation, something should be done, and to my mind, it still needs to be looked at. But the fortunate for the wealthy, planning is a lot easier and far more options are available. So perhaps that is not a fair deal, looking from a perspective of fairness. So let's have a quick look at transfer duty. Just this is for interest sake. Look at 1993. If your property was more than 50,000, you pay 500 Rand transfer duty. Can you believe that? That was 1993. And there was also exclusion if it was a primary residence those days up to a certain amount. But where we are today, and this hasn't changed, but look, if the asset exceeds 10 million, it's up to 13%. So in this way, it's a type of a wealth tax. Values of property did increase, and that to me would be more of a fairer outcome. If a person can afford a house of 10 million, then perhaps it is not unfair. But I thought, let me just show you how the tables has adjusted from years ago up until now. Right, now we've said quite a lot. What is bracket creep then? So let's just find it and do an example. Bracket creep describes a process by which inflation, now we've heard a lot about inflation, pushes wages and salaries into higher tax brackets. Now here's something new. If you win a 35% tax bracket, you could be pushed into a higher one, like 36, 37, 38, etc. And that leads to fiscal drag. Now this we hear a lot. So most progressive tax systems, and we've got one, are not adjusted for inflation because the inflation is not always that high, but in South Africa we do have that. But as wages and salaries rise in nominal terms because of inflation, one will tax more. Therefore, you need to actually adjust as you go along. And this is what did not happen this particular year. So let's do a quick example. And I'm going to make a simple assumption. Here's a family, husband and wife with 3 children. Let's say their medical aid cost is 6,000 per month, and my calculation's correct, that's 72,000 per annum. Let's just play and say inflation is 6%, but for medical aid it's a bit higher, we make that 10%. And then all along that, there was a 1% increase. I just factored it in everywhere. So when I say 6%, it's 5 plus 1, or however you want to read it. But the point is I factored the VAT into it as an additional cost, which I think would give us a fair outcome. Now, let's do an income and expenditure budget. But before we do that, let's go and calculate the tax. So if I would have a salary of 700,000, then my income would be 700,000, and look at my tax brackets in red. The band rate with 147,891, and look at the marginal rate. You see it's 39%, and that is at 56,000. Marginal rate 700,000, 39%. So the tax payable is 204. There you see your age credit. That was last year, or that people paying tax now, 14,067, which is now increased with that mere 153 rand. And then there's the medical credit. And that medical credit, remember, I took husband and wife, is 310 times 2 plus 3 times 209, and I multiply by 12, and that is 14,964. That did not go up with inflation like previous years, and it stayed the same. But the point is that this person pays tax of 175,176. So if you actually take that divided by 700,000, you would get your effective rate after taking medical credit into account. But on the left-hand side, there's your income, that's your salary. What goes out on the right-hand side? Well, just to make things easier, I assume household expenditure is 452,000, etc. The medical aid, as stated before, 72,000, and there's the income tax. So my budget, it balances, I'm okay. So let's just fast forward 1 year and to where we now with the budget speech. Note the marginal rate of 39%. And what happens in this particular instance? The marginal rate jumped to 41%. And that's exactly what they mean by bracket creep, and you're jumping into it because you are pushed into a higher. But what's not being said, what's important from a financial planning perspective, is the cash flow. So let's just run through it. My salary increased, and I assumed a 3% increase because it's tough out there, and let's just assume that the person received a 3% increase. So his salary would be 721,000. He would now be pushed into a higher bracket, and that would be the tax payable, namely 212. The age credit, we've got a little bit of relief, there's it in red, but nothing on the medical credit. Yet, our medical aid went up by 10%. Your tax due is 183,000. So that becomes an expense. Remember here, previous year, 175. So really, one could argue and say, but that's not too much. Because it isn't. It's actually digestible. But where did government get that 12 billion from? Where? It's from there. What does it mean to you? What I say, what is the effect? Well, here it is. Your salary is 721. That should be 721. Your household expenditure, let's assume 6% of that included. Your medical aid went up. You've got to pay income tax. We are short all of a sudden with 42,000. This is where budgeting comes in. So it's not only the tax, it is what am I short to have that same basket of goods. Now that accounts about 3,500 a month. Now if you would take 3,500 a month and you could have saved it every month with the inflation plus 4 strategy, which is a very low growth rate, up to 700,000 in 10 years. So one can look at this differently and say what I have lost this year because of inflation and bracket creep actually amounts to almost 1 million in 10 years time. And here comes the sad part. It's not only this year. Next year, if the inflation would be increased, the new base would be last year's base. They're not going to make up for this year. So we will pay for this forever and ever. And that's why I say financial planning is becoming crucially important. Now, hopefully I've got your attention. We've got the problem. So now let's sort out start looking at the solution. So what is inflation when we look at it from a financial planning perspective? Well, here we go. City Golf, 7,000, 1984, 2009, the same City Golf would have cost you 113,000. So you saw that with the tax brackets, they followed the same principle. With petrol, if I had to fill up my car with X amount of money, and 2018, now that amount actually 5% reduced to 4, and it climbed a little bit. So it's more or less about 5% of the car that you can fill. And that is the effect of inflation. And here comes the lesson. Why is that so important? And I always say, if you can't do investment that you beat inflation, you actually don't have an investment for the longer term. And I'm not talking about having funds available for liquidity and in need within the next month, because you can't expect, or you're very lucky if you would beat inflation. But then this is not the criteria. But any other investment, if you cannot bench it and put a portfolio together to beat inflation by a certain margin, you actually don't have an investment that kept pace with inflation. So inflation is our real enemy, and as I often say, our only friend is compound. It is time, it is term. And when we talk about goals, it's about term. Well, some goals are 20 years, some goals are 5 years, some goals are 10 years. Because we have that term, we must harness the beauty of compound interest to beat inflation. And why do we do that? In order to reach our goals. But what is the greatest enemy out there? The economy? No. I would go further. The real enemy, there we go, is greed and fear. How come? Being accountable for our actions. It is greed and fear that makes that we jump in and out of a market. If I want to make someone move, or I want to do a good advert, I will use these two emotions and I will make you move. That's why people will go for the best investment, because my neighbor's got a better one and he jumps out of the market. And that is the wrong strategy. And that has been proven over and over and over. Or fear because I chose a portfolio and my risk tolerance, the tolerance that I have, my emotional state, I cannot handle it. And now jump out of the investment. So I didn't stick the term. And that's when you get penalized. So these are the two things. And therefore, to overcome this, we need a strategy. And this is what goals-based financial planning is really doing. So we start with a goal. Now, there are many goals. It's education, vacation, and some goals are more important than other ones. So what we should do is look into the future. Focus on the goal and not the obstacle. So whether the investment return is bad, whether the economy is not there, whether we have these blackouts, etc., it is here. But keep on focusing on the goal, because as time ticks by, we're getting closer and closer to our goal. And I will show you the investments and the strategy that we follow so that we can stay on course. No need to watch every day what are the markets doing, whether the share market is up or down, what is happening with the S&P 500 on a daily basis. No, there's a bigger picture to that. So we should have a game plan, and this is what financial planning is all about. Good. So let's talk about diversification. So you're going to ask me, how do we do that? Now you can diversify. Now we can diversify in many ways. We can diversify through economies. We can diversify with economies. We can diversify with asset classes. But what I'm referring to is something a bit more different. So let me tell you the story of a person who goes to the racetrack, a punter, and he bets on a horse. So there he sees, he goes to the races and he bets on a particular horse, and he sees that this horse, it's a beautiful shiny day, is always getting a place, first, second, and third. And then one day it rains and this horse comes last. But then he discovered that at least 1 week in a month it is raining. And then this horse, on a rainy day, this particular other horse is always getting a first, second, and third place. So now he's starting to think, should I bet all my money on the horse that always wins on a sunny day? Or how should I go about? What is the best? Well, it's a risk and reward. So what you've got to do is hedge your bet. And with other words, don't put 10 Rand on the one horse, but maybe on the probability, 8 Rand on the one horse and 2 on the other one. So you will not ever get the best return, but you'll come so close to a good return, maybe a 2 Rand off. Now, when we look at goals, isn't that what we want to do? Our goal is not to get the best return, but so closely as possible to have those funds available. Now, how do we relate this in the investment world? When I say interest rates are going up, how would that affect the asset classes? The one asset class will be effective in a positive way. If I've got cash in the money market, that's great. I'll get more. But then if the interest rates would go up and I've got property, for instance, and I've got a bond, it's going to impact on my profits. So do you see how the two asset classes work together? And this is what we call by diversification, and this is crucial to any investment strategy. So let's take an example where we look at our local market yearly asset classes. Have a look there. You may have seen this slide before. SA equity. Look, SA equity in red. It is very, very volatile. But if I were to ask you, is equity, is it a volatile investment? You may say yes. But if I ask you over a period of 30 years, no, the volatility smooths out. So time, once again, is the one that's going to actually save us. So let's look at bonds. And I just took the same example. Do you see bonds jumping up and down all over the show? Sometimes up, sometimes down. Then you look at equities, and you find equities, it doesn't always move in exactly the same direction, but it's a bit more volatile. So quite clearly, we need both these asset classes. So let's go back to our soccer field theory. So I have a goal. Now this goal, I want to beat, for instance, by 2%, the inflation. So in my strategy, investment strategy, because my financial planning strategy is to have a goal or investment that beats it only with 2%. And that would usually be over the short term. So a short term asset would have cash, lots of people in the midfield, and less growth assets. Because you are more certain, but it won't be fireworks, but you'll be reasonably secured of reaching your goal. Then when we look at a CPI plus 6, what has changed? We are far more, some people say aggressive, but growth assets on my portfolio. But then I need time. So a very simple rule, if inflation plus 6%, you need about 7 years. If it's inflation plus 2% strategy, you're looking at 3 years. And so we can relate because we know the term of our goals and we know what investments we should put together, but always to make sure that we beat that with the inflation. So the conclusion is, think long term. Markets are highs and lows have historically evened out over the long term. So we work with that fundamental. And that term is closely related to your goals. So why are we doing all of this? Very simple. There's a wealth quadrant. Now on the left-hand side, I spoke about the salaried person and I spoke about the entrepreneur. They would have different risk profiles and they may have similar goals or different ones, but all of us are unique. And what we are trying to do is just like the budget. Our income on the left-hand side, we want to balance, to give purpose with our future expenditure. So we're looking in the future, and that is goals-based financial planning. So I thought what I'll do to end off is to just show you a typical example, and you can adjust it, but it gives you the thinking. If your disposable income is less, I told you, you've got options. First of all, you can increase your income. Maybe you can't do that, or before you want to do that, or you send out mommy to go and work, or your kids to contribute to the rental in the home. Since we are a sandwich generation, these things do happen, but there are other options available. And that is to prioritize your expenditure. What is crucial and what is trivial? So here you see on the left-hand side, I've got priority, and on the right-hand side, I've got time, a concept that you know. Just remember that we all will differ. So what I will do as an example, I would say certain goals I have to meet and certain I want to. Let's write them down. So let's say I have to pay living expenses. All right, now you've cut down on your budget. So your goal then, and that was just one example, would be living expenses or whatever yours would be. The term is like immediate, 1 month. I can't wait more than 1 month, or it's immediate. Then quite clearly, one would put into a money market, or you put money into your bond, you have it available. You can't bet to beat inflation. But if it is for an expense in maybe 2 years' time or 3 years' time, then inflation plus 2 can do the trick. No fireworks, but you can be reasonably certain that you'll have that amount. That could be a deposit for a car, balloon payment, whatever the case may be. Then, here's an example of 1, 2. Now, from a priority point of view, it's not important. More important to pay the living expenses. I want to travel to Europe and USA with a family. So there's my goal. When? Well, that's only in 10, 15 years. Since you've got time on your side, you can put away a smaller amount because you can have more growth assets and you've got a likelihood to reach that. And if you don't, so what? It doesn't matter. Or I can just wait another 2 years. Maybe you are lucky, you don't have to wait 15 years and you actually made the capital amount in 10 years. But you went for a goal and you will be very close to the goal, and this is what we manage. And there are other examples that I used on the right-hand side as assets and trust for benefit of beneficiaries. It's a bit more complicated, but it's like a legacy. I want to leave my one child some funds so that he can make sure that he's maintained for the rest of his life. Then you will choose a certain strategy. Then there could be another one for the wedding of a daughter or a granddaughter, whatever the case may be. And depending on those needs, the beneficiaries each would have an investment strategy. Here's the last one I want to deal with. Priority time-wise, later, education for children. I have to look after that. It's my duty as a parent. So in this particular instance, I could easily go, if it's in 10 or 15 years, could easily go for inflation plus 7 strategy. But this is where financial planning comes in. Just maybe your risk capacity, your CAN, is of such nature you don't want to miss this goal. Then you choose an investment strategy that's slightly lower. It's less riskier in terms of some people coin it in the investment world. But you contribute a little bit more, so you will not miss that goal. And this is where financial planning and investment planning and investment strategies and financial planning strategies, this is where it comes together on this, what I have shown you. And this is the way how we counter the less disposable income that we have in the budget speech. So there we have another way of looking at, just another example, essential goals, preferable goals, and discretionary goals, short-term, medium-term, long-term. And each one can be aligned with a specific investment strategy. So then, what does the financial planner, how does he add value? He helps you with this process and the selection and the management of your goals, to agree on your goals and to put together a particular investment strategy for that particular goal. Decide what is important and focus on those things while we are perhaps now going through a difficult stage. But it is quite clear things are looking better for the future. Don't, because you don't formulate the strategies now and cry later and say, I should have done that. This is the way how we go about it. So if you'd like to speak to a Standard Bank financial planner, they SMS the word, and Tiwe will deal with that. And thank you for listening. So we can take some questions now.
Thank you, Errol. Let me just check if there's any questions. For now, it looks like none yet. Okay.
No questions. Well, so I don't have to do it over again.
I guess it was clear. The question that always comes up, guys, at every session, is the session recorded? Yes, it is. This will be posted on the Standard Bank YouTube channel, which will be on the thank you note, where you can just click the link and go there. You can see all the recent Someone's typing a question, they say, wait. Yes, so on the Standard Bank YouTube channel, where you can see all the previous sessions that we've recorded, you can catch that. This one will also be posted there in a couple of days. You can get that. If you're internal and you're a staff member or you're a planner, it's on the SharePoint Planner portal as well. That's the one that we always look at. And then, like Errol has said, I just want to repeat for you as well, if you are looking to carry on the conversation as to how this affects you, as a person with your financial planning, and you want to sit with a planner, you can walk into any Standard Bank branch and ask for a financial planner in the branch. Or, like Errol said, you can contact us by sending an SMS to the number 31791. You just type in the word guide, and that will be a hint on our side for a financial planner to contact you. Or you can email us at spfccallcenter@standardbank.co.za.
Okay, we've got one question here, and it comes from Ayanda. Is it advisable to save my money overseas, and is it advisable to invest offshore, and does Standard Bank accommodate that? Yes, absolutely, we do accommodate that. Why would you invest offshore? So people are often investing for the wrong reasons, and they rely on the fact that the rand may devaluate. That is not always so. Your point of departure must be exactly as I said in the webinar. Look into the future. Now, why do you want to invest offshore? Well, I want my child to have an education, let's say, for instance, in the USA. What you will do then is you will bench against the USA currency in order to meet that goal in 10 years' time. You will not use a South African one because it's not in line, in tandem, what's happening in the US. And that's how we make the decision. When I refer to my soccer field, you'll see that I spoke about equity. Now, part of that more growth assets and a bit more aggressive, we incorporate actually offshore assets already. But from a goals-based perspective, look at the currency that you one day want to go and live, or you want to send your kids to education, and you bench it against that inflation, because their inflation, you'll find perhaps may be lower, and their markets may be less volatile than our markets. So you have a more predictable outcome over a certain term compared to ours. Go and look at the webinar we did about offshore investments, and we went into a couple of examples, also including the capital gains tax implications, whether you invest in a feeder fund or do you want to invest directly offshore, because there's a different treatment of capital gains tax the one way or the other. And then I've got another wait. So we wait for that one.
There you go, Errol.
Okay. There are so many products out there for the medium to long-term planning. Do the Standard Bank also consider products of other institutions such as those offered by Alan Gray? Look, we have a platform where there are many investments. To me, it's not, it is more about the investment philosophy. We have goals-based investments that are suitably tailored exactly for these purposes of goals-based investing. But there is other products available, absolutely, which one can also consider. Just make sure that you always tie it up with the goals-based investment philosophy, as I have discussed. But the answer to that, Masendle, is a definite yes. And we've got about 2 minutes left, and I've got another wait. Okay, we can give it a couple of seconds, then. Okay, I think Yanda, it seems like it's a long question. I suggest what you do is maybe get in contact with one of our consultants. Oh, and yet it comes quickly, and then I'm going to finish it up. Need help investing money from my tax-free account? First of all, look at the webinar we did recently on tax-free accounts, how to use it wisely and also tax effectively, because often we use the tax-free accounts and the ring of tax-free is the attraction, which should not always be the case. Sometimes for a very short-term, a tax-free account makes absolutely no sense whatsoever. So our financial planners can definitely assist you with that one. Where can you find the best rates? Unit trust, money market funds. There you have to shop around and be in contact with a financial planner. And I think that is it for the day. Thank you very much for the questions, and thanks for attending the webinar. And as Katiwe said, it is recorded that you can go and listen.
Thank you, ladies and gentlemen. We will see you for our next webinar, which will be in March. The invites will come out closer to the date. Until then, we'll see you then. Enjoy your day. Goodbye.